Let's talk to Joe. Good morning.
Morning, James. Thanks for having me back.
Pleased to have you back. I think, as usual, if we just let you sort of run through the trust and what it's trying to do, please, and then we'll go to some questions.
Okay, great. So we launched the AVI Japan Opportunity Trust a little over 5 years ago in October 2018. And the idea behind launching this dedicated Japan trust was really to take advantage of two things that we saw in Japan. The first was not a new phenomenon, and that was the fact that there were lots of very, very cheap companies, good quality businesses, trading at very low valuations. And specifically, we were intrigued by the large number of companies that had accumulated huge amounts of surplus net cash on their balance sheet. And in some cases, were trading below the value of that cash on the balance sheet. Now, as I say, that wasn't a new phenomenon, and cheap companies, and particularly companies with huge amounts of net cash, had existed in Japan for the best part of 2 decades. But what had changed when we were thinking about this in 2017 and 18 was that when Prime Minister Abe came into power and he introduced Abenomics, which comprised 3 arrows, the third of these arrows really targeted structural reforms in order to get, alongside with the monetary and fiscal stimulus, to get the economy going. And the structural reforms focused on cash on companies' balance sheets and the disregard that so many companies or management teams in Japan had for the share price. And in particular, with the introduction of a corporate governance code, they tasked companies with focusing on returns on equity, putting the cash to good use. And via the stewardship code, they tasked shareholders with acting as owners, engaging with companies, and companies indeed listening to what their shareholders had to say. Something which may sound pretty straightforward to us, but in Japan, for so long, shareholders had simply supported management, supported directors, and hadn't criticized them or indeed engaged with them at all. So it felt back then that for the first time in many years, not only did we have cheap companies, but we had a catalyst for unlocking that value via the tools provided for in the corporate governance code and the stewardship code. And the mechanism really was shareholder engagement. And importantly, the authorities were keen to emphasize that it was not only the role of Japanese companies to listen to their Japanese shareholders, but foreign shareholders also had a big role to play in it. So we launched the trust back in October 2018. It has total assets today of around £180 million. It's traded pretty consistently around NAV for much of the last 5.5 years. In the last few months, a discount has opened up along with much of the rest of the investment trust sector. But we've got pretty tight discount control mechanisms that allow for the buyback to kick in after the discount has remained above 5% for a period of time. But also, importantly, shareholders have the option to get their cash back at NAV every 2 years. And the next option for that will be in October 2024. So if we move on to the team, we're largely a London-based team comprising some Japanese nationals who bring quite a lot of Japanese experience, specifically on the management consultancy and operational consultancy side of things. We have one colleague based in Japan permanently, and that's Jason Bellamy, who's a senior industry person, and he leads the relationship building, the engagement part of the approach with companies. So Japan has had quite a lot of press over the last 12 months. It's started to re-excite investors after many false dawns over the last 20 years. And for many investors, it's been a disappointing place to have invested. And we reached the point last year when so many investors weren't really interested in Japan, and there were far more important markets, more interesting markets to think about. But that does appear to have changed. And there are a number of drivers to that change in sentiment. Firstly, the macroeconomic environment in Japan has shifted. So after many, many years of fighting deflation, and particularly fighting deflation with extreme monetary policies, there are positive signs opening up or emerging on the economic front. Specifically, we've seen an end to deflation. We've seen inflation start to pick up. It's around about the more healthy levels, I would say, than what we've been grappling with here in the UK and the US and parts of Europe as well, at around about the 3 to 4% level. And very importantly, to the economic recovery story, we're starting to see signs of wage inflation. That's the good kind of inflation that the Bank of Japan has been so keen to build. On top of that, in line with what we anticipated would occur when we launched the strategy, investors are starting to recognize that there is an improving corporate governance environment. And after years in which companies didn't care about the share price of their companies, they're now doing a lot more in order to get a better share price. And so that fits in with our expectation that Japan was not only a cheap market, but it was a cheap market with a catalyst. So alongside that, we've had Japan in local currency terms at least perform very well over the last 12 months. We've started to see foreign capital flows pick up and move into positive territory quite strongly after many years of negative outflows. Valuations are still cheap, particularly amongst the small cap companies, less so amongst large cap companies. And it's a very inefficient market. It's a market where there are over 4,000 listed companies. After years in which interest in Japan has really declined, there's a lack of sell-side research. So the majority of our portfolio companies, for example, have no sell-side analysts covering those companies. So it's in an inefficient universe, which is very good for exploiting opportunities, anomalies, and delivering outperformance. And there's a lot of activism going on. There are a lot of catalysts and events underway. There are companies doing buybacks. There are companies making tender offers and bids for other companies. So off a low base, we've really seen a pickup in activity. And that's really a very fertile hunting ground for outperformance.
Oh, okay. Now you've got some stuff on the macro.
Yeah.
Which is, I know that's interesting, but maybe we'll well, just give us the highlights if you don't mind on that.
Yeah, okay. So we don't have to go through every slide, but as I said a moment ago, the big story is that inflation is picking up. So this slide that you're on just highlights that we've seen flows pick up, so capital flows from foreigners pick up, and that's corresponded to a time in which the market performance has picked up as well. When you go on to the next slide, that just highlights the point that in local currency terms, the topic has been the strongest performing stock market, and which moves us on really to the next slide, and that is the fact that the yen has been extremely weak since we launched AVI Japan Opportunity Trust. We've suffered something like a 40% decline in the value of the yen against the pound, and that's been a real headwind to our returns. But the reasons behind that yen weakness are pretty well understood, and certainly over the last day or so, with news emerging out of Japan, there are signs that those reasons are shifting. So if you go on to the next slide, the core reason behind the shift, the weakness in the yen, is the fact that whilst central banks around the world have moved to a tightening of policy and raising interest rates, Japan has remained at the effective zero interest rates. And that has meant that that's kept pressure on the yen. Money has flowed out of the yen into high yielding currencies. And with signs that the Fed in particular and other central banks may have peaked in their tightening cycles, and investors looking forward, in fact, to declines in interest rates, and at the same time, with some comments coming out of the Bank of Japan that they are minded to end the ultra zero monetary interest rate policy that we've seen. There are signs that the yen has started to strengthen, and certainly on any kind of metrics that you might use to value the yen appears to be undervalued and very cheap.
Yeah, exactly.
So we think that the yen, having been a headwind to our performance, is likely to become a tailwind at some point. And with the fundamental opportunities still extremely attractive, that sets us up for potentially very attractive returns.
Oh, okay. But I think the core of this is really about the portfolio and what you're up to. So let's have a look at that bit.
So the thing to highlight about the portfolio is that it's a very concentrated portfolio. Key to what we do is we're engaging with every single one of the companies we're invested in. And that engagement, which we highlight or describe on the next slide, involves a very detailed process of meeting with the companies, meeting with various members of the board, executive and non-executive directors, members of the senior management team, and writing long letters and presentations focusing on really 4 core areas. And these are highlighted here on the left of the screen. So it's very important, and a key differentiator of our process is we need to build trust with these companies. We need to show that we're not an aggressive activist that's out to publicly shame them and embarrass them and tell the world that they're a useless bunch of idiots. Really, it's about showing that we want the same thing as them, and that is to improve and grow the corporate value of these companies. And whilst the corporate governance code and the regulators focused on cash on the balance sheet and the inefficiency of that, and encouraged companies to do more about the share price, companies have built up this cash over years as a safety buffer. And psychologically, whilst they will give cash back, they will have a more efficient balance sheet, they're unlikely to give it all back. And if you just go in there asking for the cash back, and that's the way you're going to get a jump in the share price, that you can take your profit back to London or wherever else it is you come from, you're just another boring foreigner who they continue not to trust. So the key really is to focus on the operational aspect of these businesses. A lot of these companies have been undermanaged, I would say, for many years. There's a lot of synergies, there's a lot of opportunities that could be squeezed out of these businesses, but they've never been pressurized to do that. So we try and come in with the answer. We've got suggestions as how they can improve profitability, improve growth, take advantage of opportunities in their industries. And that is focusing on operational and strategic initiatives. And that's quite intense. So when we look at our portfolio, it's naturally going to be highly concentrated because we invest a lot of effort into engaging with these companies. And when that goes well, we want the results of that to move the needle.
Oh, okay. And they've got some examples.
Yeah. So I mean, this is a great example. It is our largest company in the portfolio. And it really highlights the opportunity in Japan very well. So very, very briefly, TSI Holdings, it's about 400 million pounds market cap company. We own just under 10% of it now. And it's a company that operates in the clothing brands arena. It's a leading owner of some athleisure brands, some popular athleisure brands in Japan, focusing on golf, skateboarding, and other sports, as well as some more recreational clothing brands. But the key here really that drew us to the company is that when you look at the balance sheet, alongside the good quality nature of the operating business, you had assets, including cash, listed securities, and real estate, amounting pretty much, when we bought it 9 to 12 months ago, pretty much accounting for the entire market cap of the company. The share price has appreciated quite a lot since we first bought it, but it's still got a huge amount of upside to come from both the undervaluation of the good quality operating business, but also a more efficient use of the balance sheet. So, almost a sort of 40-45% discount, I would say. We've been working with management. They've started to do some of the right things. We have a good relationship with them. And I should also highlight that earlier this year, the stock exchange in Japan came out with some measures to encourage companies to do more about their undervaluation. And specifically, they targeted companies trading below book value by saying that they want to encourage companies below book to expressly tell their shareholders what they're going to do in order to get their share price up. They're going to have a name and shame list of companies perpetually trading below book. And that has led to a bit of panic in some companies and a bit of excitement from some investors who have targeted companies trading below book. So it's an example of how, or an illustration really, of how the regulators in Japan, having introduced the Corporate Governance Code and Stewardship Code 7 or 8 years ago, are constantly reviewing the effectiveness of those measures, comparing them to where they want the stock market to get to, and making regular adjustments to those codes and to those regulations in order to ensure that the outcome that they want to achieve is actually achieved within a reasonable period of time.
Right. Okay. I mean, it is interesting. So, what would you like them to do with the sort of spare cash on the balance sheet? Do you want it paid out as a dividend, or does it vary stock by stock?
It does vary stock by stock. I think what I would say is that the starting point is that these companies have too much cash sitting idly on the balance sheet doing nothing. And that's what gives rise to the undervaluation. In fact, it's remarkable that in Japan, when analysts value companies with a lot of balance sheet assets, they tend to ignore the value of those assets because they've just gotten used to the idea that those assets will sit on the balance sheet forever, and it doesn't really belong. They don't really belong to shareholders. So, first of all, stop the blind accumulation of cash. These are cash generating businesses. They're profitable. They should either be invested back into their businesses or returned to shareholders. And in a company like TSI, it's probably a mix. So sell some of the assets, certainly the investment securities, which are often cross-shareholding arrangements with customers or suppliers. We don't need that. There's a big movement to get companies to unwind those cross-shareholding arrangements and give that money back or invest it in the business.
Okay, fair enough. And you've got 8% of this.
Mm-hmm.
What's the rest of the register look like?
We'll be the largest shareholder.
Okay.
There'll be some foreign shareholders on there, and there'll be some local Japanese investors as well. It will be a mix. So typically, when we look at our ownership of companies, in many cases, if we own somewhere between 5 and 10% of the company, that will make us a top 3 or top 5 shareholder, and it will get us a seat at the table, as it were, in discussions with the board. If we own 1% of a company, that does get us a hearing, in that we're allowed at that point to submit resolutions to the AGM, and that could be quite a powerful tool. Occasionally, we'll have to be a larger shareholder. We've got one company where we're a 22% shareholder, and that obviously does ensure that we get a hearing from the board as well.
Yeah, fair enough. Good. All right. So in terms of the concentration portfolio, there's a question around here now. And what's sort of a comfortable level of concentration? Is it sort of that roughly 70%, or could you go higher still? Well, what's the sort of maximum you'd have in any position?
I think it could probably creep up a little bit. But what's likely to happen, and it has, as you said, as you can see here, it has crept up over the last couple of years. No company really goes into the portfolio at a 10% weight. It's more a process. And a more typical starting point for a high conviction idea will be around the 5 or 6% level. And then as the engagement progresses and we build our conviction around that engagement, then you'd expect to see that creep up. From a portfolio construction perspective, I'm comfortable with the largest positions being around 10% and possibly a little bit more. One thing I do have an eye on is that I don't want the portfolio to be too much of a play on a single company. So I wouldn't want the largest company to be 20% and everything else sub 10%. I think that tilts the portfolio in a more risky direction. So as long as we've got some balance in the portfolio and it's backed up by high conviction on the story, then I'm comfortable with where we are today, if not a little bit higher.
If we sort of, I mean, let's assume that everybody cleared up their balance sheet. Would then this portfolio look like a value portfolio or look like a growth portfolio?
It would look largely like a value portfolio, but with a handful of more growthy companies. So we have been able to invest in 2 or 3 more growthy type businesses at what I would say are value valuations.
Yeah, exactly. But okay, so you weren't caught then by the sort of swing against growth.
I wouldn't say we were caught. We were caught by it. We had a couple of names that underperformed, I think, in that environment.
Yeah, fair enough. Interesting. Down the bottom there, you've got 3 banks there.
Yeah.
So what's the thinking with those?
So these are regional banks. Regional banks have been poor quality investments for many years in an environment in which interest rates have been zero and companies had all this cash on their balance sheet. There hasn't been much demand for borrowing. And so these businesses have been trading well below book value. And at the same time, as regional banks, what they did was invest over the years in some of their local businesses. So the Bank of Kyoto, for example, that you see down there on the bottom, has a big stake in Nintendo, which makes up actually a big proportion of its overall market cap. And this pattern is repeated across the regional banks. So on the one hand, you've got a period of time in which they've been poor businesses, but with interest rates starting to pick up over the last 12 months, investors have been anticipating a more fruitful environment for banks. And so banks have been pretty strong performers. I think these banks are up 50% or so over the last 6 months, 6 to 9 months whilst we've owned them. And at the same time, on the fundamental and more engagement side, they're coming under pressure, like other companies in Japan, to run more efficient balance sheets. So they don't need to have all these securities portfolios that are swamping the market cap of the company. There are some activist shareholders on the register of some of the companies who've been submitting proposals that they should sell off some of those assets and pass the proceeds on to shareholders as dividends. So for us, it's a double-edged play. It fits very neatly into our macro view of what's going on in Japan in terms of interest rates, higher interest rates making these companies more profitable, but also from a fundamental valuation perspective, they look remarkably cheap. And from an engagement perspective, there are signs that pressure is building on them to be more efficient and more effective in managing their balance sheets.
Okay, great. There's a question here about SK Kaken.
Yeah.
So this is one you've held for a while, I think. So actually, maybe just if you just sort of, I think there's a slide on it. Let's do that, and you can just sort of talk us through the story, if you don't mind, please.
So SK Kaken has been a disappointing investment thus far. We invested in it at launch, and we're drawn to 2 aspects of the business. First of all, the quality of the business. It's a specialist paint company. It had a leading market share, well over 50%, reasonable, good margin business, and well managed. And on top of that, it had almost 100% of its market cap in net cash. So we were buying it at a very cheap valuation, and we were buying a very good quality operating business at a ludicrous valuation. So what's happened since we've owned it? Well, from a business perspective, they started to suffer a little bit with COVID. During the COVID environment, revenues dropped. And then at the same time, our engagement which was trying to encourage companies to do more for their shareholders, trying to put the cash to more productive use, hit a bit of a stone wall. The company's largest shareholder is a family. The head of that family, I think, is the president of the company and is in his late 80s, if not 90. He's very old-fashioned and traditional. He doesn't want to change. He doesn't want to give the cash back. He doesn't buy into the corporate governance reform. And whilst we have been submitting resolutions at AGMs and have been seeing increasing support from other shareholders, that support is dwarfed really by the family's shareholding. So it's also a very illiquid company. And one of the things, just to highlight the perspective of the company, one of the things we highlighted to the company was that based on the round lot, minimum lot sizes that exist on the Japanese Stock Exchange, the smallest amount any investor could buy of SK Kaken shares was about $50,000 worth. So quite prohibitive for many retail investors. So we suggested a stock split. They resisted the stock split on the grounds that they like to see the high share price in nominal terms. Finally, they come around to our thinking and did a 5-for-1 stock split last year. It's had a bit of an impact on the share price, but not tremendously. So where we're sitting at the moment is that it's still a good business. It's still remarkably cheap. There's huge scope for upside if they start doing more effective things with the cash on the balance sheet. And at some point, I'm sure they'll do it, but it's unlikely to be the current president who's going to lead those changes. So at some point, there might be a natural change. So we sit on the register. We continue to meet the company. We have quite a good relationship with senior management, but the family don't want to listen to us for now. And whilst I wouldn't want to have a portfolio dominated by these kind of situations, to have one or possibly two within a broader portfolio provides some interesting longer-term optionality for us.
Yeah, fair enough. I understand that. Okay, thank you. Just going back to the Mr. Holdings again, what's the sort of average size of these things? You've got no, we haven't got market cap sizes.
Okay, so it does range. The median market cap in the portfolio is somewhere around 500 million pounds, I would say. At the smaller end, you've got things like NC Holdings, which is the 9th largest holding. That's about 50 or 60 million pounds. Mm-hmm. And then at the larger end, you've got things like Nihon Koden, DTS. They're 1 to 3 billion pound type companies.
Okay, fair enough. And I know AVI Global, we talked about a couple of weeks ago, does some Japanese stuff. Is there any overlap now between the two?
Yeah, there are some overlap of names. Generally speaking, the Japanese exposure in AVI Global is towards the larger cap names. Some of them are held by AJOT, and some of them are not held in AJOT's portfolio. They're held exclusively in AVI Global. I guess even where there is overlap, the key point to make is that given the size of AGT relative to AJOT, it can't hold large stakes, large positions in relatively small illiquid names. So TSI Holdings is a case in point. 10% of AJOT, it's less than 1% of AGT's portfolio.
Yeah, okay, that makes sense. Good, thank you. Can we talk a bit about Takuma, because that's your biggest new holding?
Yeah.
Questions asking about the attractions of the waste management sector.
So this is a relatively stable infrastructure type business. It's a business where I would say management have been a little bit sleepy, a little bit relaxed, but it's a fine business. It generates GDP plus growth year in, year out. It's got quite a lot of cash on the balance sheet, so we're over 50% of its market cap. So it's been inefficiently run, undermanaged, I would say, but it's a business that's got natural growth. It's a business that investors, given the stability of earnings, are increasingly drawn to, and it's one where we see quite a lot of upside from some fairly easy measures. The communication with the market here is not as good as it could be, and there's certainly signs of lack of interest, lack of understanding from investors in Japan about the company. So one of the things we've been working on has been improving corporate communication, helping make some suggestions about some of the messages they might want to get across, and also in particular around any midterm plans that these companies want to come up with in terms of setting out their stall for the next 3 to 5 years. We found we can have quite a helpful input into the communication and the design of that gets communicated to the market. So yeah, it's an attractive business. There are sources of growth. There are sources of higher growth opportunities within that business. We're at the early stages of our engagement with the company. So we've had a handful of meetings. We've sent forward a presentation that has been distributed to the board with our suggestions. And thus far, I would say it's a fairly friendly and constructive relationship that we have with the company.
Okay, thank you. Now we said this is sort of skewed towards the small cap end of the market. Is it true that is relatively cheap compared to the large caps, the way that it is in here in the UK and other markets?
Yeah, when you look at the large cap universe and you look at the high level statistics, the metrics on the large cap indices, they won't jump out at you as being remarkably cheap. It's really when you start peeling away at the layers of the onion and you start looking at some of these small caps and you start stripping out the value of the cash and the securities, that's when it hits you that there are a lot of companies trading at very low single-digit EV/EBIT multiples and in some cases negative multiples. If you look at these businesses solely on the basis of PE multiples, they don't look that cheap either. It's really when you start thinking about the balance sheet and whether you can actually get your hand on some of those assets or do something more productive with it that you start to notice just how cheap they are.
Yeah, fair enough. Good. Okay. Is the fund geared at the moment, and how do you sort of manage gearing in it?
Yeah, the fund is geared. We've got capacity to take the gearing up to around 10%. It was roughly 7 or 8% geared up until a couple of weeks ago, but we made a sale and the gearing's come down to around 2%. It's not really a targeted level of gearing. It's more a timing one, I would say. And I'd expect the gearing to get back up above 5% in the next few weeks.
Okay.
Gearing is effectively a credit facility that is pretty cheap, certainly less than around 100 basis points.
And you're borrowing in yen, aren't you?
Yeah, we're borrowing in yen.
Yeah, fair enough. Good. Can you go back a couple of steps, just talk a little bit more about what the Tokyo Stock Exchange has been doing in terms of the corporate governance stuff, and just explain how is it actually sort of penalizing companies that don't do what it asks?
Okay, no, it's not penalizing them explicitly. It's really trying to encourage good behavior in a number of different ways. So the starting point was the corporate governance code that tried to establish the principle that companies should have return on equity targets, and that if they didn't meet those targets, they should explain to shareholders why they weren't going to meet them, or more specifically, if they weren't meeting them, how they anticipated meeting them within a reasonable period of time. And it tasked shareholders with actually saying that if companies don't meet those targets, then you can't continue blindly voting in favor of those companies and voting in favor of those directors. You should vote against. Now, if a director doesn't receive 50% support, then they're voted off the board. So that's quite a powerful tool. It's a country where directors had been used to getting 98.9% support, typically. And now we're seeing some directors seeing their support decline quite rapidly. So it's quite a powerful tool. Alongside that, they've made explicit targets that companies should be reducing cross shareholdings, which acts as a poison pill and an impediment to takeover activity, corporate activity generally. They've specifically highlighted poison pills as being bad practice. So we've seen poison pills being taken off lots of companies, articles of association, for example. we've started to see Japanese domestic investors, particularly amongst the asset management industry, really supporting the kind of things that foreign activists are saying, voting against management, voting in favor of some resolutions. And at the government level, the government pension fund, GPIF, is one of the largest owners of the stock market. And whilst much of their portfolio is invested in a passive way, owning typically in a mandate to 1,500, 2,000 companies, the managers of those mandates are actually remunerated on the basis of the value that they manage to extract and the alpha they generate from a subsection of those 1,500 or 2,000 companies, which are the ones that they target for more proactive engagement. And this is not going to be the activism that we might be used to here, but it will be just having specific targeted discussions with management on various metrics such as ROE, payout ratios, dividend yields, price to book, and forcing companies really to focus on those things and voting in favor if those objectives aren't met. And then the final measure, I would say, which I mentioned briefly, and that is the Tokyo Stock Exchange targeting companies trading below book. It's their objective that the market should trade above book value, as most markets around the world do. And so the starting point for that is to get companies that are trading below book really to think long and hard about why they're trading below book. And it's also a double-edged sword, really. It allows companies, or rather it's a two-pronged attack, I should say. It forces companies to think about their own price and relative to their book value and what they need to do about it. But it also opens up a point of attack, a point of discussion that investors can use in their dialogues with companies, and they can think about, well, you've got a problem here. The stock exchange is telling you can't trade below book. What are you going to do about it? Here's some suggestions. So it's quite a powerful force.
Yeah, great. Okay. I mean, it just, as you've got sort of reasonable list of holdings, is there just like a much deeper pool of things that you'd love to invest if you had more money, or
well, yeah, there are lots of opportunities. There's no shortage of companies that would meet our criteria. The factors really that determine the number of holdings we have are practical in a sense, in that we're a limited number of people working. The engagement process is very intense, so there's only a limited number of companies that we can actually reasonably engage with in a productive, proactive manner at a given point in time. At the same time, despite that, we would want to have a very concentrated portfolio. I wouldn't want to have more people so that I could have 50 holdings, because you can work hard, and if something's a 2-3% position and it doubles, yes, it's good and it's helpful, but if it's not as helpful if a 10% position doubles. So we want to have that concentration in the portfolio. We want to look very different to the index. We want to be idiosyncratic. And we recognize that there'll be some things that we come across that we don't have the cash for and we won't get involved in, and we'll just pass, or we'll watch it. And when we get cash back, we can potentially invest in it. And so when you look at the portfolio as a whole, the top 10 make up 70%. Then there's another layer of holdings. And then below that, there's a handful of relatively small positions. Some of those relatively small positions will become larger positions in time, as in when we get cash back from mature holdings. Some of them are holdings that are on their way out, and we'll take time to exit from them, and might accelerate that if we need cash for some new ideas as well.
Okay, great, thank you. I think we covered a lot of ground, actually. So we'll probably wrap it up there if that's okay. I should ask you about the dividend before we go. Assuming these are things, they do generate decent amounts of income, don't they?
So all the companies in the portfolio pay a dividend, and as a trend, we've seen Japanese companies increase their payout ratios and increase their dividends quite sharply over the last 5 years. policy we have is to pay out the majority of the income that we in turn receive. So it translates to a yield of around 1.4, 1.5% right now. So I wouldn't say it's a high yielding fund, but we pass on the dividend, most of the dividends that we receive.
Right, fair enough. Good. Thanks very much indeed, Joe.
Thanks for having me.
And we shall get you back again in a year or so.
Great. Look forward. Thanks, James.
Good luck with it all in the meantime, and have a good Christmas. Next with you. Thank you. All right. This is actually our last show of the year. And since we decided against doing one next week. But we will be back on the 5th of January. I'll be talking to Andrew Mahati, talking about what happened over the course of 2023. And then we've got a sort of full lineup of companies rolling out into February, and I think we've got quite a few more in the pipeline. So thanks for listening this year, and hopefully you have a good Christmas and New Year, and we shall see you back on the 5th of January.